Chapter 9, Property, Plant, and Equipment, and Intangibles. Learning objectives. 1. Describe property, plant, and equipment and calculate their cost. 2. Explain, record, and calculate depreciation using the methods of straight line, units of production, and double declining balance. And for our purposes, we're just going to focus on straight line. 3. Explain and calculate depreciation for partial years. 4. Explain and calculate revised depreciation. 5. Explain and record impairment losses. We won't be doing that this class. 6. Account for asset disposal through discarding, selling, or exchanging an asset. So for our purposes, we'll be focusing on selling. 7. Account for intangible assets and their amortization. We won't be focusing on intangible assets either in this course. 8. Explain and calculate revised depreciation where there is a subsequent capital expenditure that creates partial period depreciation. Appendix 9A, and we won't worry about that one either. Vignette video. YVR builds state-of-the-art airside operations building. Vancouver Airport Authority has built a new state-of-the-art airside operations building, AOB. The facility opened in July 2014 to consolidate all airside operations into one airside building to support a heightened level of collaboration and cooperation. This is just one of continual investments made to upgrade the airport. The Airport Authority reinvests all earnings into airport operations and development. Property, plant, and equipment, also referred to as fixed assets or capital assets. Examples: buildings, land, equipment, machinery, leasehold improvements, and vehicles. Characteristics: non-current assets used in the operations of a business to help generate revenue. Have a useful life and provide benefits greater than one accounting period. May be classified as tangible or intangible. Intangible assets lack physical substance. Examples: patents, trademarks, copyrights, leaseholds, and drilling rights. Issues in accounting for property, plant, and equipment. Decline in book value over service life. So acquisition, where we calculate the initial cost. The use, account for subsequent costs, allocate costs to periods benefited, and disposal, record the disposal. Cost of property, plant, and equipment. Property, plant, and equipment are recorded at cost, which includes all normal and reasonable expenditures necessary to get the asset in place and ready for its intended use. Examples: invoice price less discounts for early payment, freight, unpacking, assembling, non-refundable sales tax like PST, installation and testing. Betterments are costs of property, plant, and equipment that provide material benefits extended beyond the current period, are reported on the balance sheet under property, plant, and equipment. Examples: roofing replacement, plant expansion, major overhauls of machinery and equipment. Repairs and maintenance expenses are costs that maintain an asset but do not materially increase the asset's life or productive capabilities, are reported on the income statement as expenses. Examples: supplies, lubricants, repair and maintenance costs. Land is not subject to depreciation. Cost of land includes purchase price, legal fees, real estate commissions, accrued property taxes, payments for surveying, grading, draining, and clearing the land, assessments by local governments. Other costs of land. When land is purchased with a building or other obstructions that must be removed, total land costs include purchase price of building, any costs to remove old building, less any amounts recovered through sale of salvaged materials. Land improvements. Assets that increase the usefulness of the land but have a limited life. Costs are charged to a separate property, plant, and equipment account. Costs are allocated over the period they benefit. Examples: parking lot surfaces, driveways, fences, and lighting systems. Buildings. Costs include all expenditures to make the building ready for its intended use. Costs are depreciated over the period they benefit. Examples: purchase price, brokerage fees, taxes, title fees and legal costs, wiring, lighting, plumbing, flooring. Leasehold improvements. Cost of alterations or improvements to leased property. Costs are depreciated over the life of the improvements or the life of the lease, whichever is shorter. Examples: interior modifications, flooring, painting, and storefronts. Machinery and equipment. Costs include all expenditures normal and necessary to purchase it and prepare it for its intended use. Costs are depreciated over the periods they benefit. Examples: purchase price less discounts, non-refundable sales taxes, transportation charges, insurance while in transit, installation, and assembly. Lump sum asset purchase. Property, plant, and equipment may be purchased in a group with a single transaction for a lump sum price. The cost of the purchase is allocated to the various property, plant, and equipment based on their relative values. Values can be estimated by appraisal or using tax-assessed valuations of the individual assets. Depreciation. A process of matching or allocating the depreciable cost of an asset in a rational and systematic manner over the asset's estimated useful life. Depreciation does not measure the decline in market value of an asset. Depreciation begins to be recorded when the asset is put into use. Property, plant, and equipment help the organization earn revenues over several accounting periods. The cost of these property, plant, and equipment are depreciated or matched over these same periods. Revenues, cost, useful life. Factors relevant in determining depreciation are cost, the estimated residual value, the estimated useful or service life. Residual value is the estimated amount received when the asset is sold or traded in at the end of its useful life. There's three methods. One is straight line, which is most frequently used. That's one that we'll focus on. There's also units of production and double declining balance. Straight line method. The same amount is expensed each period of the asset's useful life. So straight line depreciation expense equals cost minus estimated residual value divided by estimated useful life in years. Straight line method illustration. Shoe production equipment is purchased on January 1st, 2020. The relevant data is as follows. Equipment cost $10,000, less estimated residual value $1,000, cost to be depreciated $9,000. Estimated useful life, accounting periods, 5 years. Straight line method. The annual depreciation expense equals $1,800. So that's the $10,000 minus $1,000 divided by 5. The annual adjusting entry to record depreciation to this equipment would be debit depreciation expense $1,800 and credit accumulated depreciation equipment $1,800. And on your books, your equipment would stay at $10,000 and the accumulated depreciation will increase by that $1,800 every year. And then when it's subtracted from the book value now becomes $1,800 less over each year. The book value is equal to the estimated residual value. And we won't cover units of production method, but if you're curious, you can go through these slides on your own time to see how the depreciation is calculated under this method. Same thing with the declining balance method. We're not going to cover it in this course, but if you're curious, you can see how depreciation is done under this method. Partial year depreciation. Assets may be purchased or disposed of at any time during the year. Depreciation for a partial year is recorded when the purchase or disposal is made at a time other than the beginning or end of the accounting period. Methods. Nearest whole month. If the asset was in use for more than half of the month, depreciation is calculated for the whole month. If the asset was in use for less than half of the month, depreciation is not calculated for the month. Half-year convention. 6 months depreciation is recorded regardless when an asset is acquired or disposed of. So we most often use that one in real life, but for your purposes, you're most likely using method 1. Mini quiz. Metro Motors Company purchased equipment costing $40,000 on March 18th. It is expected to last for 5 years and then sell for $5,000. Calculate depreciation for the first year using the one straight line method. Use the nearest whole month method. So the straight line depreciation expense is $40,000 minus 5 divided by 5 years times 9 over 12 years equals $52.50. Revising depreciation rates. So we won't worry about that in this course either. Changes in estimated residual value and or estimated useful life, we won't worry about in this course either. Impairment of property, plant, and equipment assets. You will be covering in another course if you pursue accounting, so we won't worry about that this time. Disposal of capital assets. Capital assets may be disposed of for a variety of reasons such as obsolescence. I don't know if I even said that word right. Wear and tear, damage, changing business plans. Accounting for disposal involves record the depreciation up to date of disposal, compare the asset's book value with the net amount received paid at disposal, and record any resulting difference as a gain or a loss. Remove the balances of the disposed asset and related accumulated depreciation accounts. Record any cash and other assets received or paid in the disposal. We won't worry about exchanges nor intangible assets. Summary. Describe property, plant, and equipment and calculate their cost. Check. Explain, record, and calculate depreciation using only straight line method. 3. Explain and calculate depreciation for partial years. 6. Account for asset disposal through discarding, selling, and we won't worry about exchanging an asset. And that's pretty much what we're going to focus on this chapter. End of chapter.